Wasson here today, and we are going to be breaking down the freight market and the economy to a certain extent. I think the big headline remains, obviously, we still have the ongoing conflict with Iran. Doesn't look to be an end in near-term sight at this point, although the president has stated that he wants to close this thing up relatively quickly. And I think a lot of the markets, of course, want this to happen. Everybody's concerned about fuel prices and inflation. And of course, the longer that we see this conflict in Iran go on, the likelihood for inflation to persist continues. And that means that we're not going to get rate cuts, which everybody seems to want to kind of spur this business activity forward this year. So it is still like an uncertain-ish environment, Thomas Wasson, that we're dealing with here in the economy, but the truckload market doesn't care.
No, and that's the crazy thing. So we're thinking, oh yeah, we're getting a rate recovery, spring is coming, and like poor old Randy Marsh in the episode of South Park, he just keeps getting beat up. These drivers are getting beat up, but $5 a gallon, drivers are like, I didn't hear no bell. And so what we're going to continue to see is, at least right now, drivers are stuck between one of two options. You've got to find a way to pass on the higher costs. Most of these guys exposed to spot are not going to get a fuel surcharge. The broker doesn't care. So what do? You just keep asking for $300 more a week until you find a limit. And so that's kind of where we're at right now, and we're thinking of the rate situation. But on the contract front, higher for longer. And so it's a situation where, talk about uncertainty and timing, there's so many different variables going on right now that, it is choppy. We're hitting some rough air, as they say in the airline business.
Yeah, I think it would do us some good to go ahead and get the market in two out of the way, because I want to talk this through a little bit further as to what this means for the rest of the year. If you want to,
let's do it. I'll start at 3 this time.
Oh, okay.
Oh, going fast. All right, let's do it in 3, 2, 1.
All right, starting off with tender rejection rates. Looks like I'm going to be starting off with tender rejection rates for a while. Tender rejections, of course, the rate at which carriers are turning down loads from their contracted shipper accounts, and that number is starting to move higher. Mind you, we do not have a weather event going on currently in the market. So tender rejection rates jumping back above 14% again, higher than they were on February 6th, which is after the Winter Storm Fern event really peaked out. This is contrary to a lot of people's, and myself included, thought that the market would soften after the winter storm effects kind of run through the system. We're not seeing that. We are at the end of a quarter. We could be seeing a little bit of seasonality, but I think time will tell in April. If this index continues to have stickiness, we're talking about significant rate inflation later in the year. Let's go to the next chart. The NTI spot rates, the last jump here, I think you can apply a lot of that to the fuel. Diesel prices obviously sticking out, carriers catching up to a lot of the retail price acceleration here, but spot rates going hyperbolic here at the end of the quarter. This is insane. I was not expecting spot rates to really pop up like this, but again, you have to discount this to a certain level because of fuel prices, but spot market is still extremely active right now. Let's go to the next chart. This helps explain that fuel price. You've got the DTS sitting there on that yellow line, which is the average retail price of diesel on the daily. You can see that thing has shot up, and that's really what's helping drive the end of that white line, which you can't even see at this point. But fuel prices do not have to get passed along in a market. You can see back during the Ukrainian invasion with Russia there, that actually prices declined as fuel prices were going up. So spot rates falling down. That does not have to happen. We definitely have a market that is extremely sensitive right now. And the last chart I want to show you, the map of spot rates as we hit the bell. Blue everywhere in the United States, save for a few white ones here.
We would say run the blue. It used to be, but it's all blue. So you just got to run somewhere, anywhere.
Every market's blue. Now I will say this, that you have to also know that fuel is a component here to some level. And my point in that one chart, which is why I wanted to extend this out beyond the 2 minutes, is to kind of expand on this concept of carriers in the spot market cannot pass along inflation, cost inflation that they're dealing with unless the market allows it.
Yep.
So we would not, even though, yes, fuel is going up, carriers don't have to pass that along unless the market is willing to take it.
Bring back to that Ukraine instance is a perfect example of a time. Let's pull up the fuel chart again with the parabolic. I want to show you that one because there's a key thing to think about, which is the state of trucking capacity relative to demand and whether fuel makes an impact. It's the other chart with the yellows, the ones on the far. Hey, there we go. Everything's going up. It's really hard for our guys in the back here. But okay, look in the middle. So we have the big yellow peak because of the Ukraine war. Look at the white in the bottom. The key thing I want you to understand is there was way too many trucks on the road relative to stuff needing to be hauled. We remember the great freight recession commentary beginning in April 2022. We started to see market conditions soften. But now that the capacity has attrited, or it's basically gone out, look on the far right. And so, it is kind of like you said, that's the key thing to say is when people say, well, Thomas, is fuel going to cause the impact or not? Well, it really just depends on if you have the pricing power. And like you said, on the spot market, it's like you're in the jungle. You're competing against other carriers and also the brokers. And so it's really like Wu-Tang Clan trying to make an album. It's like steel sharpens steel. There's no kind of fundamentals like the contract space where it's a lot more structured, hoity-toity, large carriers, big RFPs. These aren't the fat cats sitting at the backroom table. These guys are literally scraping it out in the trenches.
Yeah, and we get so hung up on fuel because it's such a headlining figure. It's very volatile. And like you said, in the contract space, there's a fuel surcharge that manages a lot of that volatility. But there's a lot of other operating costs in a carrier's portfolio here that do not get passed along. We talk about driver wages having increased significantly over the last several years. That was the number one cost. You don't get that headline, so you don't get that pressure in the market. They're not able to pass that along for the last 3 years now. So just because the underlying cost increase doesn't mean the carrier can pass them along is the point of this chart. So something that I wanted to address too, because look, spot rates are going up everywhere. What do I do? Where do I need to focus on? Obviously, you can look at the rate and say, well, these rates are moving higher, faster somewhere. But let's pull up the WRI map, the one that I have here at the end, because this paints the picture of where we're seeing capacity ebb and flow a little bit better. In a market like this, where you can say, well, fuel prices are having an impact everywhere, doesn't necessarily mean that market's getting tighter. Mind you, this is going to be the map. Is going to highlight the weekly changes in tender rejection rates that matter the most across the country. All those blues you're looking at right here, I want to point to Ontario out on the West Coast. The West Coast has, until like a week or so ago, was super dead and quiet. Now we're starting to see things percolate. Ontario and Los Angeles, and we haven't really talked about the maritime stuff, have been silent relative to the rest of the country over the last few months because it's not that time of year. They have not been a participant in what we've seen. And I think this is actually one of the big driving forces behind those rejection rates going up now is import volumes are starting to trickle in. Los Angeles is starting to participate once again in a market.
And you got to think about with this non-dom crackdown, that was one of the things, Zach, you talked about was the costs. 40% of driver costs can be attributed to wages depending upon who you ask. If you have a carrier where it's as simple economics, if a $500 can get like $1,000 in another country, I can hire a seasonal labor force and take advantage of that. And so, with this crackdown, it's really kind of one of those things where it's a political thing and an economic factor, this arbitration. But, when we're thinking about California, there is a very extensive intra-Cali operations, kind of like Texas, where one of the questions we don't know is, are these guys being impacted by the crackdowns as well? Because at the ports and at the railheads, you've got to imagine there's tiny little ecosystems of contracted drivers who all they do every day is shuttle these boxes. And so one of the big things to watch, pull up the map real quick as well. I like this map. I'm a big fan. I'm going to put on my ops hat for a minute. Ontario's hard to reposition. I'd have to, from Dallas, let's say I'm a U.S. Express. Most of my stuff is to the right of the Mississippi and the East Coast and the Central Plains. And so it's going to take me 2 days to reposition assets. That's why we can see Cali heat up out of a network. But look also at places like Minneapolis in that very time. That's another hard to reach area. Look at Maine. Shout out to Niagara bottle, Nestle water. All the water bottles are made in like Maine for some reason. And so when you're thinking of the locations in terms of these market conditions, we also have to look look at the extremities. The reason you're seeing that Minneapolis and that Maine is because check in the middle part. Look at Columbus. Look at Memphis as part of the Arkansas area as well. There's a whole lot of activity. When we see this activity go everywhere, we're going to start to see the pressure points on the fringes of these marketplaces. And by the way, look at Florida. We ain't seen nothing yet because we're waiting to see about produce season, which kind of tying this all in, bringing it roundabout. Why is Hormuz a big deal? Well, for other parts of the world, your phosphates and your fertilizers, like they get a lot of it. We're seeing fuel lines in Australia right now. Southeast Asian countries are limiting it. But ironically, the big old USA, we make like the other half of the world's fertilizers and phosphates. So for those of you fear-mongering friends saying we ain't going to have food on the table, just what is Mark Twain said, the rumors of our demise have been greatly exaggerated. And so when we're thinking about these geopolitical impacts, especially upon the domestic U.S. market, ironically enough, the U.S. makes a lot of random stuff, and this is kind of driving to light to show just how insulated we are at the moment, except for those fuel prices because of the global commodities market.
Yeah, we produce 13 billion gallons of oil. By far, I think they're actually the largest producer nationally. Iran, I think, produces 4. So, I mean, yes, it's a big deal in the context of the broader, global environment, but not necessarily for us specifically, except for the fact that it does pull, hey, if China's paying more for oil and Europe's paying more for oil, that's going to pull our oil over in those areas because just like with trucking, where are the trucks going to go? Where are you going to pay me? So the oil's going to go where you pay it, and that's going to drag our prices up as well. So I think a lot of that, though, I think the concern around the oil markets from an economic perspective, there's a push and pull in trucking in this arena, and I think it's very misunderstood. Since we are the largest producer of oil in the world, we actually get economic benefit from prices of oil going up because that money comes into the United States. We're an oil producer, and it benefits our industrial processing. We just had the S&P ISM release, and it was fairly positive. We've seen this construction and manufacturing. I'm not going to call it a boom because a 52 in the ISM is not necessarily a boom, but it's certainly like a positive uptick directionally. But there is a little bit of economic benefit that we're going to get from the price of oil going higher. Now, the counter argument to that is on the retail side and the inflation side. What is it going to do to inflation and the lack of a rate cut from the Fed? What are we going to see there? And that's not great economically. So there is a little bit of a push and pull that we need to address here. It's not a pure downside for trucking, which trucking, of course, you just mentioned, the supply side dynamics contracted significantly over the last 3 years now. I don't want to call trucking recession proof, but as you hear this recession rhetoric, the truckload carriers have already been through 3 years of a recession.
Yeah.
And so there's really not a lot of potential loss here on that sector specifically.
And that's one of the big questions too, especially when we're talking about the state of capacity, the impacts on non-domicile. And so maybe like some estimates 2%, some estimates 5%, but just like with elections, you don't need to win by 10%. You need to win by 1 or 2 or 3%. And so we're thinking about the fundamentals of a market and kind of like how much force is needed based on all this pressure. It doesn't take much. And so that's been one of the big conversations because large shippers are like, I don't know about this non-dom. Large carriers are like, I don't know about this non-domicile stuff. I hire everybody. Everyone's got an I-9. But I think the conversations for shippers and listeners at the very large Fortune 100s is this. Just like we make our own oil, we're beholden to global markets, as in we're not really in control. The market rates these carriers can charge is the exact same thing. Even though most of these large carriers are doing their job right, most of these large private fleets, they're still beholden to the actions in the spot market. And then as soon as that commoditized price rises, it will trickle down and it will impact contractual bids. And that's what we're seeing with our outbound tender rejection rate. Pull the chart back up with the tender rejection rates. I love it. I've had such a theory. You don't understand as an operations guy, what does it mean to be at 12 to 14%? Because when you're on the floor, when you're slumming it up and you're getting your teeth kicked in every day, what does that mean to you? And that tells me that people are comfortable with telling a shipper no. which for the past 3 years, it was not very comfortable with saying no. And that no could be for a lot of things, shippers. By the way, it could be that one, you hoard all my trailers. That's right. I will name and shame you if you may be certain tire makers and other automotives with your racks and your tires. So that's one aspect, poor network fit. Why are you getting rejected? Could it be the rate? Maybe it is the rate, but typically, that's a pricing decision. That's normally like you've got a little bit more of a lead time with a large carrier on that aspect. But what we're starting to see is that with tender rejections higher, carriers are feeling more comfortable with declining. And then the final thing I'll leave with you as I'm finishing my ramble is this. Structurally, the largest for-hire fleets have changed their mix, which means there is less slack in the system. What does that mean? Well, it used to be half dedicated, half OTR. OTR being what we're seeing in these rejection rates. Most of these guys have circled the wagons. We're talking, 2/3 to 3/4 of it being dedicated to protect your margins with a 3 to 5 year contract. And then you only have so much to take advantage of the market. And so what we have seen compared to previous upticks is that brokers have larger participation. Smaller fleets have had a larger participation in the routing guide. That was really good when rates were lower for longer. It is not really good now because those guys aren't as loyal, and your regular national carriers who you would hope to be able to fill in the gap do not have the assets they used to have to be able to step in. We are we're in a more volatile and fragile scenario. We're a victim of our own success because of all the technology and the cool stuff that's been making everything so sweet.
Yeah, and going into the economy now, we talked about supply. That has been the part that's been contracting. The smaller fleets, owner-operators, largely targeted by a lot of this regulatory behavior. That's the part, these low overhead operators. You can argue the bad actors, a lot of the bad actors are in this kind of segment that's getting targeted by the regulatory pressure. Those were all low-cost providers. They're like bottom end of the market. We've been talking about this for a few years on this show specifically about how if you were to track the spot rate over the past few years, it's been rising slowly. It's imperceptible if you're just looking at it, on the day-to-day. But if you look at it over several years, it kind of crawls higher and higher. And that's kind of the bad actors or the low-end operators. If you pulled up the NTI chart on the back in there, you could see this over the last few years. I think actually I only pulled up there we go. So if you look over the past few years, it's kind of slowly, gradually. You've got 23 in fuchsia. You've got 24 in the green. We actually saw a little bit of a dip below there. And then yellow, which was arguably worse than the previous 2 years, was higher. And that was 2025. And now we're in this parabolic state of being. But the one thing that has not really contributed to this market flip has been economics. We have not seen demand-side economics really as strong. Yes, there has been, like I mentioned, the ISM, PMI, all have shown some level of demand-side stimulus, especially in the flatbed side. Manufacturing looks like it's turning a corner. One of the areas that isn't turning a corner, housing.
Yep.
We just had housing come out. Mortgage rates this week just went up to 6.34% on average. This is the highest level that we've seen in several months. So we're moving the wrong direction here. And a lot of this is driven by this economic uncertainty. You've got inflationary pressure. You've got this idea that the Fed's not going to cut rates, all contributing to this rise. And then one of the big reasons that you see this, as you're looking at this chart of the mortgage rates, you see directionally we're turning up. The cost of money is going up. And the 10-year T-bill, which you're looking at there, this is what they peg a lot of mortgage rates to, or this has an influence. It's not a perfect correlation, but you can see here at the end, 10-year interest rates going up. And that's because people demand a higher rate of return on their investment because they perceive risk in one of the lowest risk assets you can purchase or bonds you can purchase. And that's really what we're dealing with, is we're seeing this growth of uncertainty and risk in the financing long-term debt environment.
And we're also seeing like almost a white-collar recession with AI. Look at the layoffs at the tech companies. When we look at consumption patterns in the U.S., for the past few months, I'll argue had been the top 20% had been providing 80%. And these are the same guys who are losing their jobs now. Meta layoffs, we've got large tech company layoffs. They'll say it's AI, but I think it's right sizing from COVID related stuff.
For sure.
You know, everyone wants to blame AI, but I think that's one of the more silent. Amazon had some big layoffs. And so the very pillar that we had left to kind of prop up the consumer, which was, you know, people in the top quintile, you know, they make a lot more money than I'll ever see. Those guys are getting let go at the primest time of their careers too. You know, a lot of these guys are in their late 30s to mid 40s. You can't get another job like that. You're an old racehorse in the tech world. And so we are seeing at the same time, the real irony, like you said, I'm going to bring this around town. Trucking may have their own mini renaissance outside of macroeconomic factors because of the supply of trucking has gone down to such an extent. We've placed a lot more barriers. And ironically, we're in a very, you know, tumultuous position right now in terms of Main Street coming ahead of the midterms because folks are struggling. I mean, for your average family, heck, I filled up my car, 15 to 20 more bucks a tank. I'm lucky. I am remote. I drive in, maybe a tank every 2 weeks. That's my privilege, my friends. I will be the first to say it. If you're a family, if I worked in office, I'd be filling up like once a week. That is 20, 40, 60, 80. That's $80 I could have at least spent on one vehicle. Let's pretend we have two working households. Now it's $160 a month I could have spent doing other things that I could have bought to create more volume. It's the trickle down. And the lower income quintiles are the ones that are the most hurt because those folks can't afford an extra $160 a month, especially when they're barely scraping by. So we are in a very interesting scenario precariously from a macro standpoint for most of the nation.
And I'm not trying to be alarmist here. If we pull up the chart of housing starts, just to put this in a little perspective, housing, of course, is a huge economic driver for freight and supply chains. Like the disruptions you see in supply chains, if housing's going well, there's a lot of demand moving through the system, not just in the sense of construction, but also the finishings, as they call it, furniture, appliances, all kind of some big volume stuff. We're not doing horribly. Like, this is not like a recessionary situation by any means. You look at the starts and permits, there's some wavering here. It's trending lower, slowly lower, mind you, over the last little bit here. But it's, historically speaking, this ain't the 2008 market. You know, this is not the big crash there. So things are not terrible. So keep that in mind as we kind of talk through some of this stuff. In terms of the news, it's weird to say this. I can't believe I'm actually going to say this, but from a transportation supply chain standpoint, we haven't seen as much news come out over the last couple of weeks. I think some things to call out here. Stuart Charles wrote a couple of articles. Rail freight, this is something that I look at in terms of economic throughputs and how much manufacturing activity we have. Rail traffic reports rail freight narrowly up despite flat intermodal. Intermodal, of course, is, you know, the component of containers. There's a little bit more retail, different freight volumes. The part that I'm talking about is the carloads, and Stuart's talking about the carloads. We've got a lot of positive green shoots. If you look at the chart that he puts in here from the AAR, the American Association of Railroads, there's some reason to feel positive about the economy because this is week over week and month over month, year over year volumes that you're looking at here. And it's actually not terrible, especially in some of the like chemicals, the farm products, like all fairly good signals economically. Not all of them, mind you. This isn't like me saying, hey, everything's great, but it's certainly not like when you hear recessionary risk increasing and things like that. These people are talking, like Moody's, for instance, increased to 34% over the last week. That's still fairly low. So just take this stuff in with kind of a grain of salt because it's not like we're seeing this looming economic collapse when we talk about some of these figures. Disappointing.
Yeah, it's one of those things where, like, for most of these individuals, especially with the higher fuel costs, you know, they've been in a very tough environment for the past few years. And so I think what you said with the housing starts, that was what we typically thought of with open deck, with flatbed housing starts. You know, you get an open deck for all the raw materials, then that spurs appliances, that spurs more furnishings, that kind of trickles down. And so that rate situation is going to be a tough one. I think, you know, looking at, I guess, trying to figure out what to go from here and more practical examples for shippers and carriers. One of the big conversations that you told me about earlier was just for many of these shippers, they're like, no, this is temporary. You know, at the end of the end of Animal House, everything is fine. Do not I think for a lot of these shippers coming into spring and into April, come up with a game plan, because your routing guides have built-in tolerances. And you had a great point I want to get your thoughts on. These guys these transportation managers have only been around for a few years in their role anyway. They rotate around just like freight brokers. So we have a whole new group, a generation, so to speak, that has never seen an uptick in the market. Is your team prepared? Do you have the bench, or do you have a few more old timers where you got to pull them back in like Armageddon and be Billy Bob Thornton and put together a crew, because now your routing guide is about to be screwed?
Yeah, it's absolutely been long enough now where I am actually shocked in a lot of my conversations that these people don't remember what it's like to have trouble finding a truck or having service disruptions. It's been 3+ years now, and a lot of these guys have rotated through. So it's definitely something to be mindful of, because this hasn't existed for a long time. It feels like yesterday for a lot of us. But the last thing I want to mention too, imports have not been participating. Last article here from Stuart, imports fall 14.5%. Anytime you see this, make sure you have some context around it. This is not Port of Oakland is not huge. It's not the ports of Los Angeles, Long Beach. Imports have been offset a little bit. Yes, we're seeing deterioration year over year, but that's on the heels of pull forward. And also Lunar New Year was a couple of weeks later this year. So definitely make sure you're reading some of these things in the context of the overall environment, because imports are down, but they're not collapsing. So we're not going through some sort of huge transition there.
Yep. Got to read in between the lines, folks.
Yep. Well, that'll do it for this week. Thanks for tuning in.